Hello and welcome. I'm Peter Martin and I'm going to be hosting the presentation for you today. I'm just going to give it a couple of minutes before I begin just to make sure that we've got everyone here with us. Just so I'm sure that you are able to hear me. If you can hear me, could I just ask you in the chat to put in a Y or a yes, or just let me know that you're there. Yeah, we can hear you. It says loud and clear. Excellent. So you can hear me. Oh, let's just go back. Okay, so in previous presentations, we've been dealing with, we looked at fundamental analysis, if you joined me for the first couple of talks, and then we looked at macroeconomic last week, and I hope you enjoyed those presentations. And we're now moving on to a different area, and we're going to be looking at technical analysis for the next few weeks, beginning today with this fourth presentation in our advanced aspects of trading course, which is trend analysis part one. So trend is a really big topic. It's a really core part of technical analysis, probably the most important part of technical analysis. And because it's so big, we are going to be devoting more than one part, but more than one presentation to looking at it. So we've got a part one and a part two next week of trend analysis. Really, it's difficult to get away from trend when you're talking about technical analysis. So even when we get onto other presentations, we're looking at confirmation and the patterns. We're never going to be moving too far away from the trend because you can't really get away from the trend because it is so important. And before we get into the presentation proper, I just want to draw your attention to this disclaimer. Please have a read of that. Very important. Everything I talk about today, it's really all about just expanding your knowledge base. Everything I say, all the examples we look at, if I look at a chart or try and do a technical study, it's for information and education purposes only. I'm just trying to give you some information. Even if we're looking at something, I'm trying to show you this is a trend or not a trend. None of that should be taken as any kind of recommendation or any kind of offer or solicitation. So really, it's just all about making sure that you got more knowledge about the subject so that you're in a better position to make informed trading choices. Okay, so let's move on to talking about the agenda for today's presentation. So we're going to start off with the introduction about trends. What are trends? Why are they so important? What different trends do we get? How can we recognize them? We're going to move on to look just a recap really about the origins of where technical analysis comes from, which is from Dow Theory. Some of the core tenets of Dow Theory really still hold today in modern technical analysis with a few tweaks. Continue to talk a bit more about trend, and then we're going to look at very important phenomena, the phenomena of support and resistance. And we'll have a little discussion about the psychology behind that. Why do we get these things occurring, support and resistance, that we can so plainly see when we look at charts? And then we're going to finish up by looking at breakouts. What are breakouts? What do they mean in terms of trends? How can we use them? And we'll talk about how we can use them actually as if we're looking to do trend following, how we can use those as a possible signal that a trend might be starting. And then we'll finish up as usual with a question and answer session. If you do have a question as we're going along, make a note of it, and then at the end we'll address it and you can send it through in the Q&A section. Okay, so trends. An introduction. We've got a really simple statement, as simple a statement as you can get to begin here. Markets trend. It's a fact. It's really just so plain to see that we can just state it that way. Markets trend. You don't have to look through very many price charts before you'll come across one where it's showing you that the price is trending. Now, trends can be of all sorts of different lengths, but they all share similarities. They all have similar characteristics. And that means that you can do the same kind of analysis work no matter what time frame you're looking at. So if you're looking at a daily chart, and looking to look at trends over a period of weeks and months, the same kind of analysis you can do there would also work if you're looking at a 15-minute chart over the next few days, say, for example. And that means that with the same knowledge, we can use the same methodology, and you can suit the time frame that suits your needs and preferences. So, someone might prefer to look at daily charts, but other people might want to trade on shorter time frames or longer time frames. Choose whatever suits you. What you do choose is going to dictate how much time and effort you need to put into it. A shorter time frame is going to require more attention in the short term. You can't just look at it on a daily basis. But if you're choosing a longer time frame, then you can just sort of check it each day. So what is a trend? So we've got three types. On the left of this kind of idealized chart, we can see there's a downtrend, price dropping. We've got in the middle, sideways trend, almost an absence of directional trend, and then an uptrend on the right. Sounds pretty simple. It's good when things are simple. You find that although these things sound pretty simple, once we get into it, it starts to become a bit more complex than that, and it's not quite so easy to recognize these things. Always when you're looking at charts, it's easier to recognize things in hindsight. Really, the tricky thing is trying to work out as things are forming. So can I ask you, can anyone want in the chat just put in a stock or an index or a currency that you would like us to look at now? So we'll just quickly have a little look on a chart and just talk about what we can see. So let's have a look. Anyone saying anything? All sorts coming through there. Let me just
I think they choose only one name.
Well, pretty good actually. What we saw, there's all sorts, lots to pick from. So let's just go over to the pro charts here. So this is in eToro's platform, pro charts, and let me just have a look at here. Let's have a look. Someone said GBP USD, so I'm going to put that in. So this is a daily chart I'm looking at here of
we can see the chart. We see the presentation now.
Oh, you're not. Oh, sorry. Let me just switch screen while I'm sharing. There we go. Thanks for that, Matty. Okay, so this you should be able to see now. Pound against the US dollar. This is a daily chart. If we wanted to change it, we could select from a variety of time frames there of periods. So a daily chart of pound against dollar. We can see that if we look at what it's doing more recently on the right-hand side, I would say that since August, I'm not actually trying to join this up, but just to give you an idea, we can see that's a downtrend. If we look at another market, let's say the price of oil, there's a nice bit in the middle here. If I just choose a horizontal line and drag back a bit, we can see how this is pretty much a sideways trend for this period in the middle of the chart. This is running all the way from December of 2022 through to August of this year. We can see that we got price just really moving sideways. It's not going anywhere. It hasn't got any real direction to it. And then if we look at the S&P, let's say the S&P 500, if we look, so, I mean, we can see prices were rising on the left of the chart, but if we look at what it's doing right now, actually, no, let's say we already looked at a downtrend. So, I mean, we can say there's the beginning of a suggestion that it might be dropping now. Who knows where that will end up? But what we've been coming out of, we can see, is an uptrend. So it's not very difficult. We're just going through a few price charts. We can see this behavior quite readily exhibited wherever we go. You're either going sideways, market's going up, market's going down. So let's go back to our presentation. So let's go through each of these in turn. An uptrend is a rising trend. Prices are increasingly getting higher. So price doesn't just go in one straight line though. So what we see is price moving in waves, and we see that we get higher peaks called tops, or higher troughs as well. Sorry, and higher troughs, bottoms. So increasingly higher peaks. You see that as the price waves its way up, it goes down, it's oscillating. But we can see that the lower swings in price, these troughs, the bottoms, are all increasingly higher. And the same is true of the peaks, where we're seeing the price swing back down. Downtrend is the reverse of this. It's a declining or falling trend in prices. Once again, it doesn't just go in a straight line. Price waves up and down, but when it turns, these lower parts of it, the troughs, the bottoms, are increasingly lower in a downtrend, and the peaks, the tops, where price goes up and then turns back down, those peaks are increasingly lower as well. And then a sideways market is sometimes called a range-bound market, or a consolidation period, or even a period of congestion. Peaks or tops and the bottoms or troughs, we can describe where they lie with horizontal lines. So we saw that when we looked at oil, we saw the price was stuck there. This is a chart of Rolls-Royce on the screen now, and we can see how in this period the price is peaks and troughs are quite nicely described with some horizontal lines. So how do we trade a trend? The basic principle, this is really at the core of technical analysis, trend following. In an ideal world, we would identify the beginning of a directional trend, so either an uptrend or a downtrend, not a sideways trend. We would identify it as soon as it forms. We would trade in the direction of the trend. So if we identify an uptrend, we would buy the market. If we identify a downtrend, we would sell the market, and then we would ride the trend. We'd go stick with that trade as long as we can, as long as the trend persists. And then in an ideal world, we would identify the exact end of the trade as soon as it occurs. And then we would get out of the trade and we'd make a lot of money. This is ideal, and it's unobtainable because we can't do that because we don't know exactly when a trend is beginning, because they're hard to recognize straight away. What we tend to do is recognize them after they've begun. There's a bit of lag involved, but we need that to have the confidence that we're seeing what we think we're seeing. And similarly, we don't know the trade is over until there's quite a bit of delay gone on, because it will turn on you and you don't know that it's over until you've given back quite a lot of your profit. So what we need to do, if in a practical sense, if we are if we're adopting a trend following strategy, is to identify the trend early enough that we are able to get enough of a profitable move out of it, and identify the end early enough that we're able to get out, so that overall we're able to take enough of a profit. Also, what goes hand in this, enough of a profit to make a profit on the trade and to offset what trades where it goes wrong, which inevitably will happen. You're not going to win every trade. That's just not possible. So there are risks involved. Spot the start too late. In other words, that we don't identify the trend early enough, or we identify it too late, so that we miss the most profitable part of the trade. We get on too much towards the end. And then similarly, we spot the end too late, that we don't get out early enough, and the trend turns on us, and we don't get into either the beginning early enough and the out early enough to actually make a profit. And then there's another risk there, which is, of course, misreading the ending and exit too soon. So this is also a danger because when we looked at those price charts, we saw the nature of how prices move, how they trend as they go up and they go down, they go up and they go down. So even when it's trending, and you're right about the trend, if you've got a trade on in the correct direction of the trend, you're going to have these kind of temptations of the price going down, and you don't know whether it's actually ending or whether that's just, a downward wave. So you might misread that, decide to get out, and actually the trend is still persisting and you've got out too early. So the techniques of technical analysis are attempts to solve these problems. So many techniques exist to try and address this because these are core sort of problems. Things like moving averages, which we'll look at in a later presentation, reading patterns, using support and resistance levels, and so on. So here's quite a famous market adage: the trend is your friend. This, when I used to work in the markets, I was told this numerous times. I almost forget how many times, person sitting next to me on the trading desk, mate, the trend is your friend. Or anytime you saw the market moving in one direction, the trend is your friend. And a little bit less well known are these second and third parts, until the end when it bends. They're no less crucial though, because really you don't know that the trend is over until it's actually goes into a different direction, which could be a downtrend or just sideways. But usually it's this giving back of running profit that you had. So you may have got the trend right, you've held it, you've had the nerve to persist with the trend a long, long time, you made a lot of running profit, but you're trying to work out that the trend is over. The way you do that is to see it moving a substantial distance enough that you understand the trend is over. And that involves the psychologically difficult thing of seeing some of your money disappear before you get out. So technical analysis attempts to identify, first of all, the trend, what it actually is. Are we in an uptrend? Are we seeing a downtrend? Are we moving sideways? Also, though, if the trend is changing or if it has changed. So if we identify that we're in an uptrend, are we seeing that maintain its same pace? Is it accelerating? Is it gathering strength? Is it decelerating? Are we seeing any indications that it's running out of oomph? Or are we actually seeing it change into something else? Is it morphing into a sideways trend? Or is it reversing entirely and moving into a downtrend? For example, technical analysis also attempts to tell us when to enter a trade. So we'll look at one method of doing that towards the end, which is when we're talking about breakouts. It also tries to tell us when to exit a trade that's going right. So where we've successfully put on a trade in the right, we've identified a trend, traded in that direction, and it has turned out to be a persisting or enduring trend. It tells us when to try and get out of that. Also, technical analysis tries to tell us when to get out of a losing trade. So this is a really vitally important skill. We're not going to cover that in today's presentation. We will come on to talking about this in more than one presentation in the future. Getting out when you've maybe followed a false signal. You've got to know to cut your losses before that starts to really have too much of an impact on your P&L of your account. So let's just do a kind of potted history of Dow theory itself, which is really the origins of modern technical analysis. So it begins really with Charles Dow, who's the father of modern technical analysis. He lived at the end of the 19th century into the beginning of the very early 20th century. And he was a financial journalist, and he was actually co-founder and editor of the Wall Street Journal. So he used to write lots of articles about the stock markets at a time when not a lot of people were doing that in a kind of very serious way. And he also invented the Dow Jones Industrial Average. He invented the Dow Jones Transport Average. And he wrote a number of articles until he died suddenly in 1902. And he never actually put together anything that was a codified thing called Dow Theory, which may come as a bit of a surprise. People talk about Dow Theory. It's quite famous, but it wasn't actually Charles Dow himself who came up with the rules or the theorems behind it. He just came up with sort of general ideas that he'd observed. And really, the person who took up the baton and ran with it was this fellow, William Peter Hamilton, who succeeded Dow as the editor of the Wall Street Journal. And he continued to write for decades more articles using these sort of core tenets that Dow had started. So Dow only did it for a few years, did it for about 5 years, and then he died suddenly in 1902. Hamilton also wrote a book called The Stock Market Barometer, which sort of included some of these ideas. So he started to sort of refine or restate some of these things. And then finally, the person who fine-tuned it ultimately into what we actually think of properly as Dow theory was a person called Robert Reyer, who expounded 3 hypotheses. And the first one of which is that the primary trend is immune to manipulation. So on the next slide, we'll talk about what we mean by this primary and secondary trends. They really, there's this big thing where it's saying the primary trend is the major overriding big move, and that's the really important one. That's the one that Dow theory thinks is the one that you should focus on, and it's the one that can't be manipulated. So they sort of recognize that maybe there's a potential for manipulation in the short term, that you couldn't rely on these shorter term movements, which they would consider almost noise. The primary trend was the most, and the primary trend, no matter what went on, people couldn't actually really fiddle with that. And then the second part is that stock markets discount everything. Now, this is really a very important part of technical analysis that you hear, really, that the price is in everything. So that any information that's out there, you don't really need to sort of worry about it individually. The market will react very quickly to anything that comes out there, and price will react. So everything's incorporated, including all the financial data that's out there, all the company information, but also all the sentiment of all the market participants. Those things are also reflected in the price. So the price in the stock market discounts everything. Everything's in there. And finally, it's this idea that Dow theory is not infallible. It's not an infallible way of making money from the market. You can't just use it blindly and it will make you money. You've got to be, a lot of care has to be used. There is lots of potential for you being misled, or your own emotions causing you to misinterpret what's going on. And really, it's just a way of improving your way of trading the markets. And some other really core ideas. So we hit this idea of the primary, second, and tertiary or minor movement. So there's 3 types of movement that you can see all at once. The primary trend is this overall movement, which is the trend we've been sort of talking about. And within that, you get other moves. The second reaction, the secondary reaction, it's always counter to the primary trend, and it's possibly a deceptive one. So Dow sort of held that this could be as much as a third or 2/3 given back of the primary trend before the primary trend resumes. And then really the tertiary movement is just kind of smaller movements. In their day, they were talking about of daily movements they would consider to be tertiary or minor, i.e. ones that are just fluctuations that don't really count in terms of paying any attention to. Other really important ideas are the idea that stock market averages confirm each other. In Dow's day, I said he invented the Dow Jones Industrial Average and the Dow Jones transport average. The transport one he quickly changed into being a railroad average. So what he would look at, the industrial average is these big industrial companies, and it's an average of their share prices, and then the railroad will be showing you what's going on with the railroad stocks. And his idea was that they had to agree with what you were seeing with each other on. So if the industrial companies were saying they were doing well, but the goods they were producing weren't going out on railroads, then that was a worrying sign. And to him, it meant that it might be a bit misleading. It was only if they're both working in tandem that he would believe, that he would have confidence in what he was seeing with the trend. Obviously, railroad is gone by the wayside in terms of its importance in the modern age. But the idea of confirmation still sort of exists, and some methods can be things in the US stock market. You might look at the S&P 500, which is the upper reaches, the top tier companies compared with maybe the Russell 2000, where it's a broader based one, just to see that you're seeing confirmation of these different parts of the economy. They also recognize the importance of volume. So, for example, the idea that if you see prices pushing up to very high levels, but the volumes are actually low that are trading on the exchange, that might be a signal that things are a bit overdone or overextended. And then if you see when the market drops, the volume's picking up, that might be a sign that in the case of an uptrend, that it's actually close to an end or a reversal. And although they did identify the importance of volume, once again, these are things that have carried through to modern technical analysis. They didn't consider it as important as price and price confirmation. Those two things were much more important. We'll talk a bit more about confirmation and volume in future talks. And then this final one, trends tend to continue rather than reverse. Now, I like a lot of the sort of core ideas. I think this is self-evident. If trends didn't tend to continue rather than reverse, you wouldn't see trends. So the fact that they exist is evidence that this thing is true. Some criticisms of the theory is this idea of lag, that you're always seeing things too slowly. You're seeing it well after the event. And that creates problems in trading naturally if your information is coming much with a delay after it's actually occurred. And also this idea that this Dow never really with any great specifics described the difference between the primary trend and secondary trend. The secondary trend can be difficult to differentiate from the primary trend. So there's the idea that you've got the big trend, it pulls back by a large amount. That's going to look very similar to if the trend's actually ended and you're not seeing a secondary trend, you're actually seeing a new primary trend.
Peter?
Yeah.
I'm just cutting you for 1 second. There is a problem in the chat. I guess something either in the setting or there is a bug. So just to let everybody know, what you write, only Peter and me can see, but not the rest of the people. If you want to ask a question, please ask it at the Q&A and not in the chat. So that way we can see it and then we will take the questions. So please only questions so we will be able to answer at the end. I'm really sorry for that. For next session, we're going to fix it, but I have no idea. I try to see what happens and I have no idea what's happening. So sorry for that. And I'm sorry for interrupting, Peter. Go ahead.
No worries. Thanks, Messi. Thanks for letting me know. Okay, so why do trends occur? No one really knows for sure why trend occurs. There are some theories. One theory is that it's caused by human nature, that people don't always behave totally rationally, and trades can be influenced by these things called cognitive biases. So people tend to respond in similar kind of ways to certain things like how recent prices, or they attribute too much weight to recent prices and they ignore older prices, and this can cause them to behave in slightly irrational ways in the shorter term. And it's a kind of crowd behavior that can cause this to happen, is one theory. Fortunately, we've got this classic tenet of TA at the bottom here. We don't need to know why. We only need to observe how price behaves. So we don't need, it's enough for us to know that markets do trend. We can see that happening. And if we are really just studying the similarities of behavior, and we don't need to worry too much about what's behind it. So really a key thing is, as I said earlier, I alluded to this idea, the idea that in hindsight, it's very easy to recognize. We started by going through a few price charts, and it's very easy after the event to sort of say, okay, that was a sideways trend. Okay, that was an uptrend, that was a downtrend. It's much, much harder to recognize it as it's happening early on, which is what we said we wanted really to aim for, was to get in as early as possible. So as we sort of described earlier, trend doesn't move in a straight line. It's an overall direction. So we're seeing the price go up and down, oscillating. And this is like a tussle between bullish forces and bearish forces. When the price goes up, buyers are getting the upper hand. When the price drops back, sellers are getting the upper hand of the market. But this is sometimes temporarily. When we see the trend, we're talking about what's going on overall. It's who in the longer term is really driving the market. Is it the bullish forces that are really bossing the market? Is it the bearish forces? Or are they taking a breather and the market's sort of just consolidating, going sideways? Because of the way that it moves, this up and down, it's not always that easy to recognize the trend. Sometimes it is. Sometimes you sort of see the market moving and it's really pretty obvious. Sometimes it can be a bit harder where it's like, well, it sort of looks like it's going down, but at the same time, it sort of looks a bit sideways-ish. And as I said before, with the idea that it's difficult to tell if a trend has reversed. Sometimes a pullback can just be a pullback and the trend is intact, but sometimes the trend has actually turned around, and that can be a really difficult time. So as we already said, we're using these peaks and troughs to try and identify the trend. And what we can do using those peaks and troughs is to draw trend lines. So trend lines is kind of like rather than just eyeballing it, it is a rough and ready and pretty old method of identifying trends. But you can get in pretty early with a trend line, and I'll show you how to draw them. And you can extend it, and this can try and give you an idea about what you might expect, and then you can judge future behavior against your trend line. And there are other methods that we will get onto in future presentations. One of those really, really important one is moving averages. You could also try and do things like, a line of best fits, but a pretty core method in TA using trend lines, drawing them on charts. So a trend line, when the price is rising, we put the trend line below price, and we try and join up the lows, the troughs. So it becomes our trend line there is like a support line. So support is where buyers are supporting the price. Price is falling, buyers come in temporarily, outmuscle bearish forces. We see a bounce and we get a support level. So in an uptrend, we are getting ever increase. The trend line shows that the support is actually ever higher whilst the trend is intact. And then when we draw a trend line for a falling price, our trend line goes above the price. We try and draw it on the highs, on the peaks, try and join those up. And therefore it's representing what we call resistance. So resistance is a point where price rebounds, a rising price rebounds, gets knocked back down, bearish forces get the upper hand. So trend lines, when we draw them on a chart, can help signal a change in the trend. So a trend can accelerate or it can decelerate. So you might have to redraw your trend lines to represent this. So I'm just going to go back to the chart package again. If we put in, let's go to IBM. There we go. So this is a daily chart of IBM, and let's grab this tool for drawing the trend line. I'm going to start here in May, and what you would do is take your low and just join it up to, so initial trend line you might have drawn here would be up to this trough here. And that would give us, you could extend it forward. And then I haven't drawn that particularly well. There we go. Where price, we can see these red candles here in June where the price actually dropped through that trend line. And at that point, so this starts to show you how it's not as easy as it all seems. At that point, you would be in a, you're worrying about, is this a retracement or is the trend still intact? And we can see that as things carried on, the trend continued. So, you know, a better trend line overall, if we redrew it, might be one that sort of comes through these troughs here. And we can see how, if we extend that on up to here, say, we can see how that support line matches up really with how the trend progressed. Once we get here into September, we can see it just sort of tests below it. Trend continues, but then it breaks below. And so this big break below would be a signal maybe the trend's come to an end. And you would know pretty early on, you might be thinking, well, this trend has come to an end. And as things carry on, we can see it had. So that's really the idea behind trend lines and how they can help you, this idea of extending them, drawing them early to join up the troughs in the case of an uptrend or the peaks in a downtrend. So you might, where we are now with IBM falling here, you don't really know, but we're trying to work out. We haven't got too much data here, but we have got 2 peaks so far. And we could draw a trend line here. And this might just give us an initial sort of thought process about just to gauge against future behavior against that. We don't know for sure if there's another downtrend there, but it looks like maybe that's what we've seen so far. The future is unknown. And I'll just go back to the presentation. Oh dear, what have I done? I've stopped my share. Give me just 1 second. There we go. Okay, so the trends can accelerate and decelerate. So when we redraw a trend line, it can be to acknowledge this acceleration or deceleration where it basically doesn't stick within our trend line. With the uptrend, when we redraw it, we saw with IBM that you just sort of draw another line on to sort of match the future as better information comes along, as we get more data about the trend. With a downtrend, when we have deceleration lines, we call it a fan line. It's because we basically creates this kind of fan pattern that you wouldn't get with the uptrend. But this is an example. Here is the price of oil. We can see this is last year. So this is in the summer of 2022. We can see that there was a downtrend in the oil price there. The initial trend line through the first peaks described quite well the trend, but then the trend decelerated and the peaks were no longer within our initial trend line. So we drew another one to match up with the next peak, and then it decelerated again, and we get a third one. There's a kind of general rule of thumb, a kind of consensus of thinking that after 3 of these, you would start to get a bit wary that the trend is coming to an end, or it might be moving into a different state, either a consolidation or a reversal. And we can see here with oil that it actually shifted into a kind of sideways trend after we had those 3 fan lines. So let's now move on to talk a little bit about the psychology behind price moves. We've got this quote from Sun Tzu from The Art of War, his famous book. The soldier works out his victory in relation to the foe whom he is facing. And we can think of the battle between bears and bulls in this kind of idea of a kind of conflict between the two, where it's a kind of tussle, and that support and resistance are a little bit like battle lines, where when we get close to these levels, that's when the activity really becomes frenetic, and people are really trying to work out who's got the upper hand. So support and resistance, really, really central to the ideas behind technical trading. It's a core concept. And really what we're talking about is a tendency for price to form peaks and troughs at similar levels. So we often see this tendency, and it's, more often than not, this is in a sideways market where we see levels coming up again and again. But it's not a hard and a fast rule. There's nothing that says the market has to do this. It's just a tendency that can be observed. So in a sideways market, consolidation phrase, the market tends to be range bound, and we get this upper and lower boundary where we have resistance at the upper end of the range, and then we get support at the lower end of the boundary. And this often happens after a temporary halt in the primary trend. So you may see trend pushing on, runs out of steam a bit, moves sideways, maybe it continues on, maybe the price breaks out a different direction. But as I said, it's akin to a battleground between buyers and sellers. Buyers and sellers, they're trading a market. They're monitoring the price, and they're constantly trying to gauge whether the price is cheap or expensive. Buyers are looking for good opportunities to buy. Sellers are looking for good opportunities to sell. They both want opposite things out of the market. And naturally, in a ranging market where it's moving, like if we look at the price chart that I've got represented here, it's when it starts getting to the edges of those ranges that they're really going to start getting involved. So let's have a look. I want to move on to sort of discuss price patterns. So this is just talking about trying to comprehend some data. What I've got here is some sample price data from Antofagasta, which is a mining stock. This is just a few weeks of data. I don't know about you. When I look at this, I really can't see anything. My mind just kind of zones out after I see about 5 or 6 numbers, and I think, I can't. Even if there was a pattern there, I can't discern anything from this pattern, from the numbers there. And the point is that it's difficult to comprehend or discern any patterns when viewing raw data. So the data in that table, that's just for a few weeks. So this is why price charts are so important, because one way we can digest this information very easily is to put it in a price chart, and then it can, if there is a pattern there, it becomes much, much easier for us to recognize it. And that's why we use price charts. So this is an example of a trading range. And this is Antofagasta mining stock. So we've just been looking at the price data for a few weeks. This is the price data in the same sort of period, but extended for a longer period. And we can see how its price was bounded within a pretty recognizable range. Now, what happens here is, because of that kind of human tendency that we zone out on lots of numbers, it still actually plays a part to a degree when we're looking at price charts. What people tend to do is they tend to attribute a sort of almost an irrational amount of weight to certain things. They lock on to certain levels, and those levels are the support and resistance levels. And they also have a bit of a bias towards more recent prices. So they don't tend to look at levels from a year ago. People tend to say, okay, what is it in the last, what's the most important levels recently? So as this thing says here, it's human tendency or bias to latch onto a few data points, and human tendency or bias to assign weight to recent data. So this is part of the psychology, the behavioral trading behind support and resistance. And because of these kind of biases, support and resistance become yardsticks by which buyers and sellers judge whether a price is cheap or expensive. So if we go back to just looking at the bigger version of that price chart, so we can see this support price A, the price is moving sideways, it bounces off that and moves higher. Anyone who was a buyer who didn't buy at that point is looking at the market and kind of kicking themselves, saying, okay, I wish I'd bought when it was down as low as that price where support A was. price bounces off A and starts to go lower, those buyers are thinking, okay, if it does get down to A again, that's when I'm going to buy. So when we get down to support B, a lot of buyers who previously had missed the rise, they come in and support the price at the same level because they think, well, that's a cheap price because I've seen it rebound from that earlier. And they assign weight to that level. It pushes the market up. And it's a similar sort of thing with the sellers. The sellers, let's say there was someone who had bought at support A, it went up to resistance A, and they decided to hold on. They thought, well, it's still rising. I'll hold on. I want a better price. And then they saw the price drop. They're going to be thinking, well, if it gets back up to that level where it was at resistance A, I saw it bounce off that. That's an expensive price. That's a good price to sell out at. So when it gets back there again with resistance B, you see selling pressure coming in and it moves lower again. We can see at support C, it's actually gone a bit lower. It's almost as if the sellers have had an extra bit of a pop to push it lower, but it has failed. Finally, these sort of constructions of support and resistance are a bit artificial, and they can only hold so long. And eventually, another reason that the buyers and sellers are paying so much attention to it is they know that there is a tendency for markets that are sort of moving sideways. Eventually, they're going to start picking up some direction. So people are always there when it gets to the resistance support levels. You start to see people trying to flex their muscles. Eventually, it does break out above that resistance point, and we get a new support level. We get the breakout above, and when it draws back, this is sort of general idea of technical analysis, is that previous resistance becomes new support, or previous support can become new resistance if it was the other way around. And we see that the support now comes in at that resistance level before the market pushes higher. And one of the problems for the people who are short once it breaks out is that they've been looking back at that range and using that as their measure of what's cheap and expensive. But now they really haven't got a measure about it's everything is just way more expensive. And they're left with, do I stay in, or do I, possibly get caught the wrong side massively? I'm already on a loss. So the likelihood is that sellers are going to get squeezed out once it breaks above, because, any smart trader who's been trading the range probably knows, well, once it's broken out, I've got to cut my losses. So anyone who's short there might become a buyer themselves as they get rid of their short position. So they get additional buying, and then you get a trend starting. So as this final point says here, once price exceeds the range, market participants have no recent yardsticks to latch onto. And maybe they start looking at older timeframes, looking for other support or resistance levels that have played a part in the past. So there are two approaches to trading a sideways market, a ranging market like the one we've just been looking at there. One is range trading, which is those people that you're trying to buy when it comes close to the previously observed support, and then you sell when it comes up to where you've observed resistance. You're trying to trade those bounces between the support and resistance. If you're doing that, then obviously timing and risk management become crucially important, because one of the reasons that trend following is, just to go back, we look at the magnitude of price move once it starts to get direction and trend compared to the magnitude of the price moves that are available when it's within the range. And we can see that the price moves within the range are much smaller. So therefore, there's a limited amount of upside to be made if you're getting it right, range trading, compared to the potential downside you could get when you're the wrong side of it breaking out. So you have to, risk management's really important. Timing's really important. Your profits can be ruined by that breakout, because everything you've made on your range trading could get completely turned around with interest if you don't get out in time once it breaks out. So breakout trading is really doing the opposite. You're not getting involved when it's range trading. You're sitting back, sitting on the sidelines, waiting to see who actually wins out. There's a fight going on between bears and bulls. Why don't we see who's the winner? When we do see which way it breaks out, we say, okay, I can see someone's won that battle. I'm going to join the winning side. So when breaks out on the upside in that example, you buy the market and hope that a trend is formed that is going to persist for a long time. So you buy if the breakout is to the upside, and you sell if the breakout is to the downside. The problem with the range trading, as well as things I've said there about timing and risk management, important profits can be ruined by a breakout, is that ranges can be difficult to recognize quickly. So sometimes it's like some time has passed before you recognize the range is there, and it may not persist long enough to actually trade it profitably. So there's as I said, these two different approaches, the two different lines of thinking, but the trend following line of thinking would say, well, range trading is not really worth doing, and its trend is at the heart of technical analysis because there's bigger profits to be made. That's why you focus on the trend. That's that line of thinking. So breakouts, we've just had an example, really. Let's talk about that a bit more. So breakout occurs when price clearly exceeds prior support or resistance levels or zones. So I say zones here because support and resistance, a price where it forms a peak has met resistance. That's a resistance level. A falling price that bounces to form a trough has got some support. That's a support level. When we see repeat behavior, we start to call that, well, a support zone or a resistance zone. And these aren't precise levels. They might be close to each other because it's a tendency. Price might peek its head a little bit above or below these, or it might not quite reach them. But if it's in that region, then we call it support or resistance zone. But once we clearly break beyond this zone, then that can be a signal of a major trend in the market. If it breaks to the upside, that might be the start of a new uptrend. If it breaks to the downside, it might be the start of a downtrend. So it's really important for technical traders when this occurs, but we have to be careful. False breakouts are common. So in other words, a lot of the time when this breaks out, it doesn't actually end up in a new persistent trend. Sometimes it can just actually come back and get back into the range. It doesn't mean that the breakout has always leads to a trend. It doesn't. In fact, it's probably more common that it doesn't happen. So some methods of confirming that it has happened. So one way is is really where you want the bar to close a period on the breakout side to confirm. So one method is rather than just an intraday break. So if we were talking about a candle representing a day, but it wouldn't have to be a day. If you were looking at a 4-hour period, it would just be a 4-hour candle. But you're looking for that candle to close on the breakout side would be one method of confirming. And we would consider that if it breaks above the breakout zone that you've attached, but it closes below it, then that's more likely a fake or a false signal. If you want to be safer, you could wait for 2 bars beyond the breakout side. That's a stronger confirmation, but there is a cost in terms of time and possibly profit. So if the trend is a fast one, it's pushing up higher, then you're going to be buying in at a higher price if we're talking about an uptrend. And similarly, if you're talking about a downtrend, you'll be selling into a lower price. So you're waiting longer to be right, but you're getting a worse entry level. So there's a bit of give and take on the two. Between the two, obviously getting in earlier can be at the cost of being wrong more often. And you don't have to. You could, in theory, wait 3 or 4 bars. It's a kind of time-based entry. And you might introduce even further rules to confirm it further. For example, that you want to see increasingly, if you were seeing a breakout to the upside and you're looking to confirm that, you might look for closes that are increasingly higher. The same thing sort of applies, though. You're waiting longer. It's with the risk of costing you time and possibly profit. Another method is to actually just set a percentage level as a filter. So you see as a certain level that you think, okay, this is my breakout level, rather than saying, okay, time-based, I'm going to wait a candle or 2 candles or 3 candles closing above that level. Why don't I add just a certain percentage on, let's say 3%, and then if I see that break above that level, it gives me that little bit of safety or wiggle room. I'll be that much more confident. I've confirmed that it has broken if it could get all the way above that filter. And then this idea of volume, again, volume is another confirmation tool. So you could look at the volume. Higher volume suggests more power behind the move, more oomph. So the idea here is if you're looking at, say, a stock, then you would look at how many shares are actually trading at that price time. So you look at on the day it broke. If it was a daily chart, you look on that day, what was the volume? If it's really high volume compared to when it was trading in the range, that suggests, okay, there's quite a lot of strength behind this push. So here's an example, just a case study of Antofagasta again. So we were looking at that sideways range in Antofagasta. This is sort of really the same period. So we're looking back into the chart here is showing most of 2022 and into early 2023. So we can see that we had that sideways range from July through to November, and that's bounded on the upside by the red line. And then we get the breakout where the red circle is, breaks out to the upside, and the new trend forms. And that new trend does last for a long time. We can see it carried all the way into early 2023, and then it started to get more of a sideways character to it. So something we need to be aware of is volatility. It's really the enemy to a degree of the trend follower. Volatility can really help you. If you're in like a range trader and you're trading a volatile market there, then the swings in price can help you. If you're a swing trader, that can help you as well. But if you're a trend following trader, then volatility is difficult. The more volatile the market is, the more it oscillates. So the more it's whipping up and down. And basically that means the more noise there is, the harder it is to discern what is actually going on. And also, on top of that, a volatile instrument, because it's whipping around, is more likely, just in the course of its whipping around, to sort of get through a zone that you're looking at where you think, oh, this is a breakout, but it may not actually be breaking out. It may just be that's its natural whipping around. So one way to try and combat this is to try and adjust your breakout zone filter accordingly. So you might try and adjust it for volatility. Now, there are more than one measure of volatility available to us. If you cast your mind back to our DCF analysis, you remember that one of the measures of volatility we looked at there was beta, which is really looking at a stock and comparing how much it moves against a benchmark, say the S&P 500 index. There's also standard deviation as a statistical measure where it describes volatility of how a price moves. But a common measure, a really good one, a really useful one for technical analysis is ATR, the average true range. It was dreamt up by a guy called J. Wales Wilder, who's sort of like the modern father of technical analysis. He came up with lots of useful things that we are really common and commonly used in technical analysis, like relative strength index and the parabolic SAR. So average true range, measure of volatility. I'm not going to get heavily into how it's calculated, but he came up with this idea of the true range. Obviously, the simple range of a day is just the high minus the low. Wilder came up with this idea that you could include the previous day's close. So then if the market had gapped above that, actually it's more volatile than the normal range represents. So you sort of factor in the previous day's close and work out the range as being what's the biggest part if you're looking at the high, the low, and the previous day's close, which is whichever is the bigger, the high minus the close, or the high minus the previous close, or the low minus previous close. Whichever gives you the biggest number, that's the true range. Then the average true range is just the kind of average of true range values. So let me just flick back to our charting package again. So let's have a look at, we got a Rolls Royce, let's say. See Rolls Royce on the daily chart here. Trend line. I don't really want a trend line. What I wanted was a horizontal line, but it doesn't matter. So we can see it was sort of range bound in this period. here, and then it's clearly broken above. If we added on so I'm going to do it in here in the platform itself. So this is average true range. I've just added it on as an indicator at the bottom. So we can see how this expands or contracts as volatility increases or decreases. So what you can do is take the value of this. We can see that it's sort of alternating on here between a low here of about 3 up to a max up here about 7.5. And we can see when we get the breakout, can you see what happens? That vol actually expands massively, and the volatility was pretty depressed during the sideways movement. So what we would do is we sort of, on any given point, when we see the breakout here, I mean, it's a pretty clear breakout with Rolls-Royce, but we look at our ATR and it's saying about 5 there. So if we were saying that previously that our upper range was 159.5, we'd add on whatever our ATR value is. Let's say it's 6 for the sake of argument. We would add that on and say, okay, we need to see a break above our level of what we consider to be the resistance level, which is say 159.5, add the 6, we would be looking for a break above 165.5 before we would consider it a confirmation. But we can see that it's gapped so clearly above it that we would just take that as a break if that was the method we were using. So that's just a simple example of how we can use a measure of vol to try and adjust our breakout level that we're looking at. And let me just go back to the presentation. And so this slide here shows basically the same thing there. So ATR is a measure of vol. We've got that Antofagasta chart we were looking at before. We've got the resistance level that when we were observing the range, and then at the bottom of the screen, the ATR. And it would be the same principle I've just described. You take the ATR value, add it on. Now you might add it on. You could actually add that just to what you consider the resistance zone, or you could have your 2%, 3%, or whatever filter value and the ATR. And once again, all of this comes down to your own discretion. Use what you think works for you. Use what works best when you've looked at previous studies and suits your method of trading. So, in summary, trends are a core concept of technical analysis. So we've talked about the trend, uptrends, downtrends, sideways trends, what they are and why they are so central and so fundamental a principle to technical analysis. We've also looked at how breakouts are a key signal. Breakouts above previous zones of resistance or below zones of support, the key signals that the trend may have changed direction. But breakouts that we see can be false. We need confirmation to trust that those signals aren't false signals. Always bearing in mind that a false signal is always a possibility. So no method is foolproof. We saw from Dow Theory the idea that none of this is foolproof. You can't just rely on it guaranteeing you to make money. That's not how it works. These are all just attempts to try and solve a problem of how to trade the market. There's lots and lots of tools and indicators, as we will see in following weeks, that have been dreamed up to try and address some of the problems we've come across. And we've talked about some of the problems that it's hard to identify this. None of this is easy. And so signals can be false. So it's really important because of that to experiment and use what works best for you. Look at lots of charts, practice using these tools, be honest with yourself when you go back to look at previous case studies, it's very easy to sort of look at it with that hindsight clarity and just say, oh yeah, I'd have got that right. But imagine that you don't know what the candles are going to do next. You are working blind. You've only got the data previously, and you're trying to work out what's going to happen next from that, and use what works best for you. Okay, so that is
Peter,
yes.
I have a question because we're done and there is some pretty major collapse in alpha beta today. I wonder, probably people asking themselves what such a move can mean for the chart of a company. Because sometimes, you know, there is like the short term when, I don't know, something moved 2% versus the long term. Would you mind looking at the chart and giving your point of view, obviously with no recommendation or anything like that? Is just like trying to address something that I know that concern many people because it's such a big company. So
Sure. All right, we'll have a look at it. So first of all, I mean, this is actually a good opportunity to address something that I didn't bring up in the talk, but is probably actually very much worthwhile talking about, is about time frames and how the time frame of looking at a chart can very much alter your perception of what you're seeing. So we're looking at here currently a daily chart. And we can see from this that Google or Alphabet was previously doing pretty well. So if we were to get our trend line out and look at what we had before, yeah, so we would initially just joining up, this was like maybe you'd have a trend line here, and then we can see that the trend was decelerating. So maybe we would say, yeah, we've got a trend here. And then obviously the price move that Matty's referenced here is this huge break below what was. And so first of all, we talked about trend lines. With an uptrend, the trend line below represents a support line. So price has clearly broken massively below where there was previously support. So just when we're talking about breakouts before, the obvious thing that we would, you know, using that line of thinking is that here is a breakout to the downside. It's a massive signal that there's potentially a big change occurring in the trend. What we could also do, therefore, is to look at other time frames to try and clue us in a bit more, because they do give you a different perception of what's going on. So we could try looking a time frame above. So this is the weekly chart of Google or Alphabet. I always call it Google because that's the way I think of it. Now, in this context, one of the things that this does allow us to do is to go back and try and look at, because we talk about people latching onto previous levels. We can see that if we were thinking about big support, we can see here. I mean, it gives us, first of all, just some great context about what's going on with Alphabet, and that if we go back to the end of last year, we can see the price is hugely below where it is now. So this is suddenly this move, you know, it's broken down a lot, but it's not such a huge move in terms of the context of where the price has been in the sort of relatively recent, but long-term recent, you know, couple of years.
So basically, if I understand it correctly, if you look at the really narrow daily, you see like a crazy break.
Oh yeah, absolutely. If we
a little bit extract it changed the whole picture.
Yeah, so that exactly. So what, you know, we've looked at one way, which is to go longer above, and that will make things look a little bit less. But if we go short, so we go one below here, we're going to go for a 4-hour chart. Then we can see, you know, here's the trend lines that we drew on the daily chart, and we can see just how much it has gapped. There's a big gap in the price there. Maybe we want to look even, you know, which time frame we use really depends on what time frame we're looking to trade. So it's up to you what you want to use. Use whatever is convenient to you. I tend to personally to look at daily charts unless I'm looking to trade a very short term time frame. But whatever you do decide to use, obviously that is going to dictate to a large degree what kind of time frame it is sensible for you to be trading. But if we look at an hourly chart, I mean, it all really, looking at this for the first time, and I actually haven't been looking closely at this, or haven't done any kind of a technical study. This is new to me. I mean, it's funny because it dovetails so closely in with what we were just talking about. So this is a breakout to the downside. I mean, if you were implementing a trend following strategy, you'd be very interested in this. Is it now heralding a potential new downtrend? And we don't know, but it's this could be a signal, but it could be, as we were warning about, a false signal. You never know, it could come back. But we'd be very interested about implementing a sell because it's broken so substantially to the downside. It's a bearish signal. But there are other people out there who will take a different view, which is the idea of, well, this is now cheap. I mean, if you were potentially, let's say you weren't even coming.
A buyer there, you would be a buyer here. So,
well,
yeah.
I mean, there's
it's always like that,
it brings up the idea of, I do like market adages, but there's obviously one, never catch a falling knife, and this really is, an example of potentially catching a falling knife. At the same time, our old friend Warren Buffett has a saying where he says, in the Buffett household, we like hamburgers. When hamburgers are cheap, we buy more of them. So there are always two ways to look at it. From a technical point of view, though, it is almost a classic breakout signal to the downside. Even looking at the shorter frames of 4 hours or daily, it's broken below.
I think you answer my point, because I mean, I'm a fundamental guy, obviously, and this creates an interesting point, because I mean, obviously, Google report. I read the report. I know the excuse in the market is regarding the cloud. This I'm talking from fundamental perspective, because it started until quarter ago, it started growing with the net profit before obviously taxes, and this quarter it's still in net profit, but it's lower than the previous quarter. And then the market is questioning, wait, maybe I gave too much price for that. And that's why the gap today, that's why they're crashing today. Whether it's making sense or not, well, time will tell. But I think my point was, and I clearly understand that, is that if you were a day trader, really looking only for the day, you don't care about, I don't know, a week or even a month, you may be burned. But if you're looking a bit longer, as you just showed, there is still a way large gap that they can continue going down or maybe continue correcting. So it's a bit, can make confusing. But I think when you guys, and I saw from many of the comments, when you see something like that in a chart, there is always good to spend a bit time on fundamental and try to understand what's going on there, okay? Because I've seen in my career many companies going down 10%, day after they get fewer buy recommendation, and boom, they're going up the same whatever percent they went down at the same day. So you need to take a look at that. So I mean, we can take some question if you want at the Q&A.
I mean, we're running a little short on time, but certainly we can handle
try
one or
to take
two.
maybe the mainful one that's relevant to the course. You have few there, so just choose whatever you want, and whenever you finish, you can close the session. And for the question about the recording webinar, you guys can just use the link you registered here and rewatch it.
Okay, so we've got a question here, which I think it's saying, is there a difference for technical analysis trading indices or commodities or actions of any company? Well, there are schools of thought that sort of feel that certain types of technical trades are better suited to certain markets. I don't think there are really any kind of hard and fast or general rules that apply that differentiate these asset classes from each other. So in the broadest sense, technical analysis really should be able to be applied the same methodology sort of agnostically according to what asset class it is. So the same things, the same concepts of trend following, the same concepts of support and resistance, breakouts, all these kind of concepts should apply equally to indices, to commodities, or to stock prices. Obviously, when we talked about Dow theory, it was originally conceived as a method for trading stock prices. So Charles Dow himself it was quite a narrow thing he was looking at. He was looking at, there were just 12 companies in the Dow Jones Industrial Average when he came up with it. So he was looking at 12 big companies there, and he was looking at, I think it's something like 9 railroad stocks were in his railroad index. So it was pretty narrow. He was looking at the biggest companies in those fields, but he was studying the price action and deciding based on that. I mean, in a future talk, we're going to talk about volume. Volume tends to lend itself more to stocks because the volume information is more readily available, proper volume information about what's actually traded. If you look at a market like the foreign exchange market, FX is a beautiful market in all sorts of respects because FX is insanely liquid, the most liquid market that exists. It's a properly 24-hour market, which has other implications for technical analysis because day candles don't quite mean the same thing as markets where there actually is an end to the day when the market shuts. But Forex, what's called an OTC market, over the counter, it means that foreign exchange, no volume data is available. So there's a bit of back and forth, but in general, the principles should apply irrespective of asset class. Someone asking about will we address biases we have is a cause of pain for many investors. Would be quite beneficial to know about for everybody. Really, I mean, I touched upon 2 of the more important ones in the talk, which is the idea of the anchoring bias, which is to sort of attribute too much information, too much importance to just a few random data points, or and then a recency bias is where you sort of do it to things that are too close. So an example of the anchoring bias really is where you walk in, and businesses are aware of this, the fact that people, if you know nothing about something, you haven't got much information to go on. So what do? You try and cling to anything you can find. So if I'm going in to buy a new, let's say, I don't know, a new laptop, and I haven't bought a laptop in a long time, and I don't know how much laptops cost, what I'll do, most people will do this, they go into the store, they'll look at what's an expensive one, what's a cheap one. Okay, those are my yardsticks, and I'll make my decisions on buying it basis those things. So I've anchored on to any data that's available, even if it doesn't necessarily make sense. I might have wandered into an extremely expensive store, but as I say, businesses are aware of this, so they will sort of have certain things that are really ridiculously expensive just to try and push people's expectations up. And the same sort of thing happens we saw with prices with support and resistance, where people sort of anchor on whether it makes any sense or not to sort of just a few things they've seen in the market. They think they attribute too much significance to it, really. They're not looking back to what the price has done 5 years ago, 2 years ago. They look what it's done the last week or month. And that's once again, that's also a recency bias. And there's a few other of these things. And these things exist for a reason. They what we call sort of mental heuristics, rules of thumb. They exist because they're really useful. It can be really useful not to have to actually sort of perform a proper statistical study to make up a decision about which is the best supermarket to go to for me. We use kind of mental shortcuts to get to an easy answer. That's the way the human mind works. but it doesn't work very well for a stock where it's got 10,000 data points in a year. So we need to actually be a bit more dispassionate, use price charts, and use some of the techniques and technical analysis, try to actually find profit out of these kind of quirks of behavior. Maybe Matty can answer this one. There's a question here. Does eToro have a little course or primer on how to use all the new technical analysis tools in the charts? Which is a great question.
Yeah, I actually shared the link. Well, I shared that. Let me reshare it again. We have a course about the trading view. I'm within eToro, so I'm sharing it with you. I mean, technical part, how to use trading view. And in additionally, we're in talks now with TradingView to bring some professional guy from their perspective just to explain really technical part, how to use it in our platform. So stay put for that. But what I just sent, that's probably going to help some.
Cool. And then we've got another question here, which I'm gonna, just because of time, it's gonna have to be the final one.
Sure.
But it's a really good question, actually. How important is it to line up the wicks, or is it just enough to align the candles while drawing a trend line? So what I'm going to do is I'm going to go to the charting package here just to talk about this. So let's have a look. Let's just go to the S&P again. I'm going to get rid of my trend lines because these were really rough when I drew them and I wasn't paying any attention to anything. So I'm going to zoom in just so we can see a bit more what's going on. No, I don't want that. So we're talking about the wicks and the candles. So we've got these Japanese candles, this big red one. We've got a wick above it and a wick below it. The top of the wick represents the high of the day. The low of the wick represents the low of the day. Top wick high, low wick low, and then the body represents the open and the close. So it's a red one, then the close is at the bottom and the open is at the top. And then if it's a green one, it's the other way around. The question is, do we use the wicks to draw the trend line, or do we use the bodies? The facetious answer is yes. You can use either. I would recommend consistency, whatever you do choose, whilst also bearing in mind that this is, like a lot of trading, more art than science. It's inexact. You can't expect these things to be right on the money. They're trying to describe the overall trend of a price that is whipping around. One line of thinking is that you should use the wicks. Another line of thinking is you should use the bodies. The bodies thing, I do tend to have a tendency to do this myself, although it's not necessarily that rational. If you're looking at a daily chart, and I do tend to use daily charts more than any other, the body represents the close or the open, i.e. not intraday price movement, stuff and there may be some more additional, there's an argument to be made to give some more additional weight to that, because a day trader might be willing to push the price to more extremes that someone who's holding a position beyond may not. However, a lot of the time when we're looking, as I said, Forex is 24-hour market, that doesn't really apply. If we're looking at something that isn't a daily chart, and increasingly these days people do use quite short time frames, if you're looking at a 4-hour chart, 15-minute chart, then the candles themselves are a kind of arbitrary interval of time, and therefore we shouldn't necessarily ascribe too much to the open and close periods of those. So it's quite valid to use the wicks, and that's really the answer. You can use whichever works best for you. I mean, always my answer when it comes to this is I like to keep things simple, and I like to use what works for me. And as I said, I would use some measure of consistency. So, I mean, we can see a fanning effect coming in here, where if we were to listen to that initial one, we've got a bit of a fan, it's decelerating. And that's, the example I've used here is joining up the wicks, not the bodies. but you can use either. And that is the last question. I'll just go back to my presentation. Thank you. Thanks very much, everyone, for attending.
Thanks,
I
Peter.
hope you enjoyed it. Thank you.
Yeah.
And thanks. And make sure you join us next time, because we're going to be doing some more, the second part of the trend analysis. Going to be looking at things. I'm pretty certain we've got moving averages next week, which is one of my most used tools. So please, if you came today, make sure you come next week as well. Thank you very much.
The word moving average all around, so that's probably going to be one of the most interesting. Well, for me at least. So yeah.
Anyway, see you next time. Bye bye.
Bye bye.